The general rule is that the amount of tax payable is dependent on the intended use or manner of recovery of the asset. An asset may be recovered through use or through sale, and there is also an exception to the general rule. Here, we focus on the recovery of an asset through sale. The critical factor in the calculation of deferred tax on revalued assets is the tax base. So, the focus here is the middle part of the flowchart. When an asset is intended to be recovered through sale, there are two possible circumstances that would affect the tax calculation. That is, circumstances where capital gains tax or CGT is not applicable, and circumstances where CGT is applicable. The tax base of assets are calculated as the carrying amount plus future deductions minus future taxable amounts. Where CGT is not applicable, each component of this formula is determined in the same way as assets held for use, with the exception of future taxable amounts. This is adjusted for the revaluation, but the adjustment is limited to the original cost of the asset. Consider a plane with an original cost of $10 million and a CGT cost base of $10.5 million. On 30th December, the plane has a carrying amount of $8 million and a tax base of $7 million. On 31 December, the plane's fair value is $11 million. What is the deferred tax income or expense if the owner intends to sell the plane and CGT is not applicable? We can calculate the tax base by substituting into the formula. The new carrying amount is $11 million. The future deductible amount would remain at $10 million. The entity is not going to get additional deductions because of the revaluation. And the future taxable amount would be $10 million. That is, it was adjusted for the revaluation, but this was limited to the original cost because CGT is not applicable. The tax base is thus $8 million. You should note that the CGT cost base of $10.5 million provided in this example is ignored since CGT is not applicable. The plane has a carrying amount of $8 million. The revaluation of the plane results in an increase of $3 million. But we know that CGT is not applicable, so we need to determine the capital gain portion and split this revaluation into the portion that is taxable and the portion that is not taxable. To do this, we need to consider the original cost of $10 million. The plane increased in value by $2 million to get to its original cost of $10 million. Then it increased a further $1 million above the original cost to reflect the fair value of $11 million. The portion above the original cost indicates the capital portion, or the capital gain portion. This portion is not taxable because CGT is not applicable. Only the $2 million of the revaluation would be taxable. The deferred tax expense would be $600,000. We can also use the grid to calculate the deferred tax expense. We can substitute the amounts we know before the revaluation and calculate the missing amounts. Temporary difference is $1 million and deferred tax balance before the revaluation is $300,000. After the revaluation, the new carrying amount is $11 million. The tax base we calculated is $8 million, and the temporary difference and deferred tax balance can be calculated. The revaluation column is the balancing amount, and $3 million increase is the carrying amount column, and $1 million increase in the tax base column. This gives us a temporary difference of $2 million. As this is a debit balance, it indicates that this is a taxable temporary difference and thus gives rise to a deferred tax liability. The deferred tax expense is $600,000. $600,000 is the deferred tax expense on the revaluation. The $600,000 tax expense can be confirmed when we refer to our earlier calculation. Using the same example and facts, what would be the deferred tax expense if CGT was applicable? The tax base calculation would be affected when CGT is applicable. We would still use the same formula, but the determination of the components would vary. Carrying amount would still be the same. Future deductions would be calculated as the CGT cost base less accumulated tax depreciation. Future taxable amounts would include the full revaluation. Unlike in the case where CGT is not applicable, the future taxable amounts here are not limited to the cost of the asset. The new carrying amount is $11 million. The CGT cost base of $10.5 million was given. You should note that this will always be given to you and you are not expected to know how to calculate this. The accumulated tax depreciation is $3 million. Remember, if the original cost was $10 million and the tax base before revaluation was $7 million, it indicates that there was an accumulated tax depreciation of $3 million. $7.5 million will be the future deductible amount. $11 million would be the future taxable amount, as this is the full revalued amount. $7.5 million is the new tax base. We know the carrying amount before the revaluation is $8 million. We also know that the original cost is $10 million. And CGT cost base of $10.5 million needs to be considered because CGT is applicable. The first $2 million of the revaluation takes the carrying amount up to the original cost. This is fully taxable. This is an increase of $500,000 above the original cost and up to the CGT cost base. This portion is not taxable. And finally, there's an additional increase of $500,000 above the CGT cost base. This represents the taxable capital gain, and hence it is taxable. If we add our taxable portions, we get $2.5 million. Times this by 30%, and we get $700,000 as our deferred tax expense. This is confirmed when we populate our deferred tax grid. To recap, when the intention is to sell the asset, the deferred tax on revaluation would differ depending on whether CGT is applicable or not. The tax base under the different circumstances is critical to the correct calculation of deferred tax.